How to legally pay zero in taxes. If you're paying more than 15% in taxes, you're either uninformed, moderately retarded, or you're playing the wrong game. W-2 earners, you're taxed first, and you spend what's left. Producers, we spend first, invest, depreciate, deduct, and then we pay taxes on whatever's left, if anything. This video isn't tax advice, it's tax strategy. It's what the IRS tax code actually says when you stop playing defense and start acting like a capitalist. And today, I'm gonna show you how to legally pay as low as zero or near zero in taxes using the exact playbook that oil tycoons, real estate moguls, and producers use every single day. So let's break down the producer tax code versus the consumer tax code. There's two different tax systems in America. 95% of people are in the consumer tax bracket, but they don't need to be. And you're in the consumer tax bracket if the majority of your income is earned and you pay earned income taxes. Like if you're a W-2 employee, a contractor, or have a salary, okay? Now there's also one for producers. That's the wealthy. That's the investors, the business owners, and the capital allocators. Now in the consumer code, you earn a paycheck, the government takes its cut before you even see it, and then you get what's left. You pay taxes on every single dollar. Then you try to save whatever is left, and that's where you're landing at. In the producer tax code, you earn money through a business or an entity, you write off expenses, you leverage depreciation, you use strategic deductions, and then you pay tax, and often on almost nothing. If you ever wondered how someone making $500,000 in passive income pays less in taxes than a surgeon making $300,000, it's not magic. It's the tax code rewarding productivity, risk, and capital creation. Now, for example, real estate isn't just a wealth builder, it's a tax weapon, and that's why you see so many millionaires that are born out of real estate. One of the most powerful tools in real estate is called depreciation. So let's say you buy a $1 million property. Now, before I get ahead of myself here, I want to break down a couple things, okay? When we talk about making investments, you don't have to do it alone. You don't have to become a landlord owning real estate, okay? We'll break down a couple of those things later on in this video. This is simply to showcase that you don't need to be paying the type of taxes that you are paying. And if any of this is new information that I'm going over, it means you have something to learn that you should be paying attention to, because the longer you go without paying attention to it, the more it's taking out of your pocket, out of your wallet, out of your bank account. Okay, so let's just say that you buy a $1 million property. Now, the IRS says you can depreciate that over a 27.5-year period of time. But with something called cost segregation, you can accelerate that. And the result is this: you might deduct $200,000 or $300,000 in the first year alone. And that paper loss offsets real income, even from other sources. Add in things like mortgage interest deductions, repairs, and you've got a multi-layered tax shield. This is why producers buy real estate. Not just for appreciation, but for paper losses that protect cash flow. I'll give you an example. Take this building that I'm in. This is a 16,000 square foot commercial facility. Originally, this was designed as 4,000 foot facilities that different businesses could rent out, whether they were dentists or an automotive shop or a bed liner spray company or whatever the case may be. This is 16,000 square feet altogether, and when you do cost segregation studies, what you're able to do is start itemizing certain things, real property from other property. So you can put things on a depreciation schedule where the roof can be depreciated over a certain period of time, the trusses, the electrical components, the furniture, driveway, the landscaping, things like this. And so it allows you to come up with a schedule of depreciatable items that you can offset against passive income. So let's say this property, for example, is generating $100,000 a year in passive income, and I'm able to find $70,000 worth of depreciatable items in this year. That means that my tax basis on that passive income is now only $30,000 instead of $100,000, okay? Hopefully that makes sense. If you're brand new to the channel, make sure to subscribe so that you continue learning more things about how to actually build wealth outside of the modern financial system. I am not woke, I am not politically correct, and you're gonna learn nothing but the truth here based on fact, based on logic, and based on what the IRS doesn't want you to know, what the financial advisor can't teach you, and what Professor Asswaffle in college didn't know to teach you because they were too financially illiterate to teach you. So you're gonna learn the real strategies that multimillionaires and billionaires use, and that's what you're gonna find on this channel. Let's continue on. Another great tax savings method when it comes to investing, it's a very elite strategy, and it's what the top 1% use consistently: oil investing. Specifically because of intangible drilling costs, where you invest directly into an oil well whole, not buying a stock, not buying an ETF, but actual wealth. The IRS lets you deduct up to 85% of your investment capital up front. So if you put $100,000 into a drilling project, you might get up to $80,000 or $85,000 in deduction in the year you invest, whether your oil well hits or not. And then there's something that's called the depletion allowance, where 15% of the income you earn in the cash flow is tax-free. So you're looking at real income with minimal tax. This is how the rich fund their lifestyles with cash flow, not W-2 jobs, and pay less taxes than you. Now, a couple other things I really like, something called the Augusta Rule, or even hiring your kids. Most CPAs haven't even mentioned it to you, and why would that be? They're too busy filing taxes, not studying tax code. Here's how it works. You can rent your home to your business up to 14 days per year at fair market value, and that income is tax-free. So say you rent your house to your business for meetings at $1,000 a day. That's $14,000 in tax-free income deductible by the business and non-taxable to you. Then there's hiring your kids legally. If you own an LLC taxed as a sole proprietor, you can actually pay your kids up to $14,000 a year in the year 2025 as we're making this, and it's deductible for the business and it's not taxable to your kids. So now you've just shifted taxable income into a zero tax bracket and taught your kids how to build wealth as well. And the next thing we gotta talk about is entity structures and trusts. We gotta have a defense optimization. The wealthy don't just invest in things personally. They control everything through entities and trusts. So you want to look at using LLCs or series LLCs for liability protection and income channeling. When you invest under an LLC, it stands for a limited liability company for a reason. What this means, for example, is if I own a house and I put a tenant in it, and that tenant fries their baby to death on a frying pan for some reason and wants to sue me, they can come after me, and through me, all assets I personally own, they would have theoretical right to in a lawsuit. Now, if that home is under an LLC and I am separate from that LLC, and tenant's cooking or whatever, baby hops in the pan, they fry their baby to death, all right? Well, they can only come after what that LLC owns in theory, right? So then there's what's called series LLCs. Imagine that you own 5 real estate properties. You own 5 single family homes. You would have property 1 and LLC 1. You'd have property 2 and LLC 2. You'd have property 3 and LLC 3, and so on. And what that does is if one of these tenants fries their baby and this one's baby goes in the oven, and then this tenant trips over the stairs and breaks their neck or something like that. None of these things have actually happened. I don't think there's been any fried babies recently. What you're able to do is if they go after you, they can only go after what that LLC owns. So you minimize what assets are in that LLC rather than having, all 5 houses under one LLC. You have individual ones. And while an LLC might cost you 50, 80, 100 bucks to set up, it is risk mitigation, and you're lowering the chances of anything happening to you or your personal liability by using a series LLC structure. Which brings me to my next point. You want to look at using management companies to control expenses and tax positioning, and then use things like trusts for asset privacy, estate planning, and reducing inheritance tax. Everything that I own is structured this way. My name is nowhere, but I control the entire portfolio. This is how you build legal invisibility and strategic protection while keeping your effective tax rate in the single digits or lower. If you look at Jeff Bezos's effective tax return rate for the last several years, it's about 1.2%. Little Mr. Zuck is right there too. Now, while they might be outwardly green, saying, oh my gosh, like preach positivity and let's all have rainbow flags and let's do this and make a safe work environment and have 56 pronouns to your name, they are capitalists. Okay? They don't pay taxes. So while they're out there convincing you, hey, go green and drive your Prius and eat grass and environmentally conscious tofu, okay? They're out there investing in oil, gas, real estate, making energy deals, and making sure that they keep their taxes looking like this, okay? And here's another problem that a lot of people have, a shitty CPA. I'm gonna say something loud for the people in the back. Your TurboTax isn't saving you money. It's keeping you a broke middle-class citizen. If your CPA isn't proactively bringing you strategy, then you're paying for nothing. You need someone who understands entity stacking, asset level depreciation, strategic income shifting, and understanding how you're going to invest in the moves you want to make, and even going back and looking at old returns where you overpaid the IRS. And here's the simple truth. The tax code isn't broken. It's doing exactly what it is supposed to. Rewards producers, punishes consumers. If you're sick of working harder only to pay more in taxes, if you're earning 6 or even 7 figures and still writing checks to the government every single year, It's time to stop playing by their rules. So let's recap what we've talked about today, guys. We talked about some of the best tax saving strategies when it comes to investing. We talked about how the capitalists and the producers are rewarded more than the consumers, the two different tax systems that exist, and only one of them, unfortunately, you've been educated on, while the other you've been intentionally miseducated on. That's why we want to expose you to this. And we talked about what wealthy capitalists do to build their empires and get out of the modern financial system. So these are the things that you want to be learning. If you have any questions at all, drop them in the comments. I reply to every single intelligent comment that I get. So make sure to drop a comment below. And if you're brand new, make sure to subscribe, smash that like button, and I'll see you in the next video.